Hello investor, how are you? Hopefully you are doing good. In today's video, I will cover the Walgreen Boot Alliance, as you can see, and the ticker is WBA. So we'll find out by doing the stock valuation, is it a buy or not a buy. This ticker is requested by our one of the YouTuber. His name is Michael99, as what the name suggests on his account. So he did comments while viewing my Costco stock valuations, and I have put that in a list. So that's what today I will be doing. So the agenda for today is, actually, today I'll start with the WBA, the ticker name, the stock chart first. Usually I won't do that. And then there is is it a private or not private? That's what I will try to highlight. What are its margins, like gross revenue margins, gross profit margins, where the company stand in terms of the margin. And then we go to the liquidity, and then on the stock valuation, as I'll do the net profit model, enterprise value model, and a free cash flow model, and then we'll form an opinion based on that, right? Whether it should be going or not going for this ticker. Okay, so let's get started. So let me put myself on hide. Yeah, before let's get started. Hi, just to save time, I have already bring the Walgreen Boot Alliance, the company, and the ticker is WBA. This chart. This is on the weekly basis, but as you can see, this is on the 5-year, and then we have the price here. Why I'm showing you this? The reason why I'm showing you this, that the coronavirus hit sometime near here, right? In March time, right? That's where the most of the companies see the dip. But the one major thing what I like to show you here, the company has the problem right even before, which reflects in its chart very clearly. If you can see that the company make its high around 26th of November 2018, and after that it's significantly dropped from $84 to $68, and then from that onwards it's just dropping and dropping. Before that, it did another hike, which is a long time over in 2015, but then it just dropped, and then stock just stays at around $80 level, and then it's dropped. So this means the company has something going on here, so which we'll see as on. So one thing then it makes me that what other information maybe I can able to find about the company, and you can see here, when I was searching for something that I find that there is what a potentially private Walgreen would mean for the market. So there is a rumors that maybe that it can be go from a public to the private company, right? Which is not a very good sign. So usually it does when the company is not doing very well. So that's what also I like to highlight here before we go further deep. Okay, so far we have seen the chart, and from the rumors going on that its company can go private. So we have covered these two. Now from the next decks and all, I will take you go to the spreadsheets, and then see the financials, and then try to find out the company. But before we do that, let me try to come back and introduce myself. Myself is Pramod Kumar. I am a CFA charter holder and FRM certified. In my channel, I do the stock valuation, and also for example, like you can check on my channel, I did most of the stocks, and also like stock analysis, where I just try to or IPO, if there is any IPO come out and it's trigger me, or mostly the YouTuber who view my channel, they put a comments, and I also review, just like today's video is requested by somebody. So that's what I'm doing that. Otherwise, which is in my mind, or something new coming which get my attention, I'll do that. So feel free to check out my channel. If you like it, kindly, I really appreciate if you can do a subscribe if you're new, and give a thumbs up. That really appreciate that. Okay, so enough about me. So let's continue our journey. I hide myself so I won't block anything. Okay, so let's get started. Okay, so continue with the WBA margin side. As you can see, this is, I am right now showing the revenue margin growth rate and the gross profit growth rate for the last 10 years, right, from 11 to either the year over year growth. So here you can see almost at 11 it was around 5-7%, but then in January 15 the growth comes around 35, which is very good, but then it's keep dropping, it comes up and then it's drop, and actually the gross profit growth is even negative, right, and the revenue is not very good. It's pretty much below even 10 years where it started, as you can easily see from the chart. Okay, so next is, let's go to do the liquidity check, and so how the company is doing in terms of liquidity, and then we'll use the models to drive the prices. Okay, here on the screen I didn't paste it there, so I think it's easier to show here as well. So you can see this is the three main the liquidity ratio, the current ratio, the quick ratio, and the cash ratio, which is highlighted in three different colors. This is our, on the y-axis is our scale, and then on the x-axis is the time horizon for 10 years. On the y-axis, anything above 1 is good and anything below 1 is bad. So you can see all those three ratio from the last 2017 onwards is way below and pretty much close to zero, right? If I say the very conservative cash ratio, but even the current ratio is not good. So this means if on the and like the crisis like these, the company really has a hard time to meet its short-term liability. If you don't understand this, just browse on my search on my channel. I have a video on explaining how to calculate this and explain this, not only this but also on the profit ratios as well. Okay, so let's go next. Let's see on the PRAT model. I think I didn't put in the agenda, but I really like to show here what's drive the return on equity and what's the driving the returns. So basically, if you can see the net profit margins for the last 10 years, right, the year over year growth, and this is our average, right? Average is 3.36. So on the year over year growth right now, and when the year end from their 10K is 2.91%, right, which is below even their average. The operating margin is again, the EBIT, which is close to operating margin, is again very low for the 2019. So seems like 2019 is not good. The only thing which they are doing right seems like for the last 5 years, which driving their return, is pushing the debts, right? So you can see the debt is continuously rising, right? So that's one. And the second thing is the asset turnover ratio, basically how much the income is generated by the same assets is also a decline. It's keep declining. You see from 2.57 it's keep declining, and then it little bit increased from the last 3 years, but it's still, actually it's just like a close to average if we can give them some grace, 0.1 of 1 basis point, right? Not point, but just 1 basis points. Okay, so but overall I think what driving the growth here is the debt, which is pushing their returns, and nothing much, right? Yeah, and so since their operating some bottom line is low, so that's why their retention rate is high, so tax is low, right? So that's why this is high. Okay, so let's have enough of what's driving. So let's continue with our three models. We'll go use the three model and determine the price of the stocks or the intrinsic value. So here again, if you here I have shown you the 10 year of data based on that from their 10K, and this is, I'll just estimate based on the 3 quarterly and then what will be the next quarter. So pretty much estimates the one more year of the earning, right, based on the current 3 quarters and plus one more quarter. But if I just show and this is the top line, this is the revenue, and this is the earning per share. Okay, so for the 10 years, and this is the estimation. If I just ignore the estimation just for the simplicity's sake, and because this has some estimation, but what's the actual, the revenue growth rate year per year, which you can see here is 7%, and the 5-year is 5.76%, which is low, right? But at the same time, you can see the net profit is declined by 1.15% year over year, which is not a very good sign. So this means even if the company is making little bit less from their 10-year average, but the bottom line affects a lot. Okay, so in this one, what I have done, I have also so I have taken the current net profit based on my estimations, because it really reflects what's happening right now, and then I base and on the net profit growth, because I just take the 2.75%, right, and then decline that to the 2% with some spread, and the growing the net profit for the next 10 years, and assume that I'll sell the company around 15.17 of the PE. How I come up with this? I'll use the normalized PE, and actually if I just compare their current PE, which is right now 51.29, and the industrial PE as well, which is 37, which is, I don't think so is good, it's all skewed. When I compare with their normalized PE, basically I take their earning per share for the last 10 years, and for that and I just divide by the price, so that I come up with this PE. If I just compare with its own normalized PE, we can easily see the company is right now over expensive, right? It's very expensive right now, so it's not a good time to buy. So that's a quick check, but still we want some dollar number, and that's what I got requested, so I'll finish this video for that. Okay, so so I'll sum it up. I use the discount rate of 10%. As you can see, all my stock valuation, either I want at least the minimum of 10% required return. If I don't get 10% required return, I just better off invest in S&P 500, right, rather than on individual stocks. So that's my benchmark threshold. And then I use this to discount the growth or the net profit to come up with the present value, sum it all up, and then divide by number of outstanding share to come up with my price of the first model, which is $27.27. Okay, so let's go to the next model, which is the enterprise value model. In the enterprise value model, so here I also have 10 year of data. This is the average outstanding shares. This is the price for the last 10 years. As you can see, the price really gone up. It's from 27s to 50. Is not it gone up at 1.86, but it then dropped, as we can see early in the chart. The market cap is 26 billion. Now it's 40. It went up one time to 90, and now it's 46. As you can easily see, the large portion of the market cap, basically, let me finish first. So and then we have this total debt, which is increased significantly, and the cash. So enterprise, then I can compute the enterprise value, which is nothing but the market cap plus debt minus cash for the next 10 years, right? And we can easily see the out of 60, the debt has a huge portion of the market cap, right? It's 16 billion, almost 17 billion dollars. Okay, so it's coming back here. If I see the enterprise value for the last 10 years, if I see average, it's grown at the rate of 8.63%, but on the last 5 years, it's decline, right? Which is even worse. I haven't seen honestly, I'm seeing so many companies, but never see the enterprise value decline that much, right? On the year-over-year basis. Again, the EBITDA for the growth is also declined, but the debt is, you see, oh my God, you see the debt is on the 10-year CAGR is 22% rate is increased. Maybe that's their main problem. They grow that so fast as compared to their enterprise value, right? So that's the main problem. Okay, and in the last 5 years they have control, but it's only grown at 3.2. 0%. Okay, so if this is one of the good ratio I'll usually see as well. So if I compare the enterprise value or EBITDA, it's around, it goes from 6, now it's 8, which is okay. But at the same time, debt was less than half, right? And now it's 2.32%. Okay, so let's say what this model gives. So just to use this model again, I'll use estimate the current EBITDA. This is the after 2019, because we have almost the year end is coming. So that's one of the reason I estimate based on 3 quarters plus 1, and so that's the current EBITDA I have used. And then I have grown that EBITDA only at the rate of 1.95%. The reason is because my EBITDA is negative, but I don't want to use the 10 years EBITDA here. So that's why, just to be conservative, I take 1.95 and pretty much just very smoothly grow to a 2% for the 10, and assume that company, and I'll sell the company at the rate of 3.9 at the terminal value, right? So that's how it is. Okay, so then I have a discount rate of 10%, compute the enterprise value by using the average debt and cash, divide by number of shares, and got my second model price, which is $42.29. Okay, so let's go to the third model. The third model here, I'll go quickly. Again, I have same operating cash flows for 10 years, capital expenditure, and to come up with the free cash flow is nothing but sum this together. This is negative, this is positive, and this is my free cash flow left. This is my price. So my free cash flow yield is going from 10.89 to 8.73, which is not bad. So basically, but if you can see, my free cash flow growth rate for the last 5 years is negative, right? And in the last 10 years is 3.63. So I only use 0.56% and then very slowly grow it to 2% for the next 10 years, and then I sell the company at the terminal of 8. Right, just being consistent with the because of these huge debts. Okay, so discounted with 10%, again same story, divide by number of shares, and then I got my price of $37.76. So now I have, let me come back. So now I have three shares with the first model, second model, and third model. I put the equal weights. This is my weighted price. I sum it up and got $35.79 is my price. If I go to the market right now, the price is $42. So with a grain of salt, honestly, this has that's the price. I don't think so. I'll say that it's the to discount. I'll say maybe it's right now it's at the average or fair value, just to give some grace or margin of safety. If you want, you can add, but I think it should be enough. I did a lot. So what do you think from the price? This is the price I get it. Do you think it's you still go and buy the stock? You want to wait? Please put in the comments. If you're new and you like the video, please do hit that like button. It really promotes the video, and YouTube think is it beats the algorithm. I really appreciate you have given your time to me to watch this video, and if you can subscribe to my channel for this video. You can check some other video on my channel, and if you want me to cover just like this, request your stock, please put in the comment, and I really like to do it. So I'm myself, Pramod Kumar, a CFA charter holder and I'm FRM certified, signing off from today's video. And thank you very much again to staying with me, and I really appreciate your time. Bye for now.